Now that you have created a monthly budget, you now know how much you have to save each month toward buying your home. That's an important first step. In this section, we're going to look at your income and expenses again, but this time we'll look at it in the same way your lender will. When you created your budget, you used your net income, your take-home pay. When a lender looks at how much you can afford for a house payment, they look at your gross income. Remember, your gross income is your total income before anything is taken out. Lenders use math calculations called ratios. It sounds complicated, but they are basically looking at your income compared to your debt. Knowing how the lender looks at this helps you understand how they decide how much you can afford. We talked earlier about pre-qualifying for a loan as part of the steps in purchasing a home. In a few minutes, you will use a pre-qualification worksheet similar to the ones lenders use to look at your income and debt to see how much you can afford to pay for a house payment. When lenders loan you money, they are taking a risk that you may not be able to pay it back, so they carefully review your current income and debt to help make sure you don't agree to pay more than you can really afford. There are two ratios lenders consider. Let's look at them one at a time. The first is housing, or the front-end ratio. This is how much you can afford for principal, interest, taxes, and insurance, your mortgage payment, as we discussed earlier. Lenders have different requirements based on the kinds of loan programs they have, but usually the housing ratio is somewhere between 25 and 33% of your gross monthly income. If your gross monthly income is $1,000 and the lender's housing ratio is 33%, you can afford to pay $330 per month for principal, interest, taxes, and insurance. The second is the debt to income, or back-end ratio. This includes your estimated housing payment plus any other debt you owe, such as car loans, school loans, or personal loans. This ratio will be different from lender to lender, but it's usually between 36 and 41% of monthly gross income. Using the same example as a moment ago, if your income is $1,000 a month and the lender's maximum debt ratio is 38%, the most you can afford for all your debt combined, including your housing payment, is $380. The more you owe on other things like cars and credit cards, the less money you have to buy a home. That's why it is important to work with your housing counselor to create a budget, pay off credit cards and other loans, and get financially ready to become a homeowner. Take a moment to read the information to the right of this video. Then over the next few screens, you will use the text and charts to practice pre-qualifying yourself. At the end of this exercise, there will be a brief written summary of this section on Are You Ready to Buy a Home? There will also be a test. But first, practice pre-qualifying. Just click Next to get started.